Hello, good evening, everyone. Thank you for having us again. Welcome to our Tech Talk episode 2 series from the series Unlocking Capital and Compliance: How the Nasdaq Private Market is Reshaping Private Company Growth. In episode 2, we will be talking about building liquidity with confidence inside the mechanics of private market transactions. Now, before I delve in deeper, I would like to thank our sponsors and our media partners, K Media Marketing, Borneo Post, Utusan Borneo, Sihua Daily, and TFM Oriental Daily. Now, going on to the episode, welcome back to Unlocking Capital and Compliance, the series where we explore how private markets are transforming, fueled by intelligent tools, better infrastructure, and growing investor expectations. In episode 1, we introduced the Nasdaq Private Market and its mission to bring transparency, structure, and trust to private company transactions. Today, in episode 2, we take you deeper into the operational engine of private market liquidity, how structured liquidity programs are designed, how compliance is embedded, not bolted on, and how companies can unlock capital without compromising control. Whether you are a founder navigating secondary sales, an investor seeking efficient access, or a legal or compliance leader managing risk, this episode offers a hands on understanding of how liquidity is being delivered with confidence, clarity, and compliance. In this episode, we are joined by Dr. Ahmad Moradi, CEO of Maxwell Rand Inc. and Meta Exchange AI Inc., a technology company that recently completed a successful listing on the Nasdaq Private Market. Over to you, Dr. Moradi.
Greeting everyone. Thank you for having us. Welcome to Tech Talk Show. The purpose of again our project and programming and the distribution is to inform, communicate, and educate. And with these topics in mind, we feel that there is a ever-changing dynamics that is going on, and some of these areas that we feel that it's important for purpose of creating wealth, uh, helping startup companies, growth stage organizations to reach out to a level where liquidity will no longer become an obstacle. I had to go through this journey myself. Running a 28-year-old company, Maxwell Rand, gave me the ability to do a project that we call Meta Exchange AI Inc., where this company essentially we took it in 2 years from zero to $300 million market cap. And now what we are doing is creating the ability for our stakeholders through a secondary market to obtain liquidity and sell out their shares without compromising the value of the company. We call these steps a two-step NASDAQ listing, a pre-IPO followed by an IPO when the time arrives. According to PwC, the average IPO has risen from 5 years to 15 years. So one of the challenges are smaller companies really no longer can afford to compete with the larger organizations with their incentives, stock option plans, and a lot of other derivatives that they incentivize their employees to join them in order to attract new investments and new opportunities as well as talents. Then you need to have a diverse package, an effective package. And that is one of the reasons last week when we presented, we said, in this timeline, if you hire an employee that is 20 years old, by the time he gets his stock options exercised, he becomes 35. So you don't want that because those entities and with the dynamics of artificial intelligence and the ever-changing the market with the blockchain and the cryptocurrency and the Web 3.0 and moving to the Web 4.0, now you have a diverse and more complex that the entrepreneurs don't know where to start. So for this reason, one of the things that we are doing in here, we are trying to bring the context of this process to you And then when you need assistance, you can definitely reach out. And with the consultative approach, we can guide you or help you to reach toward the next level. But the most important thing it is that the anatomy of the structured liquidity programs, that it is not about one-off transactions, it's about architecting a scalable network for shareholder liquidities. Because one of the most important things is you have angel investors, you got family, friends investors, you got solicitation investors, and they all, the reason they participate with you, they want to have exit strategy and liquidity. So the secondary market that it comes together gives that opportunity that Nasdaq back in 2011 started this journey, and last year they were able to provide $140 billion of liquidity to mostly the companies that they are trading on Nasdaq Private Market as an exchange. So with that in mind, I felt it is important that we share a video that it was sent to us, that it explains by the CEO of Nasdaq Private Market in an interview session with some of the fund managers in an objective course of why Nasdaq Private Market is a perfect situation for the companies, that they're doing in excess of maybe $3 to $5 million in revenue. They have audited financials, they have valuations, and they have pro forma financials that it can be structured to become a Nasdaq Private Market listed company. And more importantly, to give you the opportunity to meet with the accredited investors, not threat actors under KYC and AML, and bring that liquidity to your organization and to your stakeholders. So with that in mind, we are going to share this video. Take it, listen.
Navigating Equity Compensation, a webinar series hosted by Countsy. Welcome to Equity Matters, Navigating Equity Compensation, a webinar series hosted by Countsy. Today, we will discuss the secondary market and tender offers with Tom Callahan, CEO of Nasdaq Private Market, Martini, founder of Countsy, and Kareem, founding partner at Compass Strategic Advisors. We hope you enjoy this conversation, and Kareem, now over to you.
Well, welcome everybody. I'm glad to have everybody here with us, and we are going to have a very interesting conversation today about the private market. I think even my mother, who's 87, knows about the private market these days. That you can't turn anywhere anymore and not have an article or a news flash about it. It's definitely become something that everyone wants to talk about. Excited to be joined by Martini from Countsy and Tom from Nasdaq Private Market. Tom, would you mind just giving everybody a quick introduction on your background and NPM?
Sure. Well, first of all, Kareem, thank you for having me. Your mom is more informed than mine is. I think she thinks I'm still a stockbroker, although I've tried to explain what I do for a living many times. But I am the CEO of Nasdaq Private Market, and we're a company that services other private companies, and we assist them with managing their liquidity, largely for their employees, but for also early round investors. And it's really a story about how the capital markets are changing, and there's more private companies and they're waiting longer to IPO. And that creates real liquidity pressures for private companies, and we try to help them solve those problems. Great.
And Martini, can you tell us a little bit about yourself and Countsy?
Sure, I'm the founder of Countsy. We do outsourced equity administration for larger private, smaller public companies. And we also, of course, do outsourced accounting, finance, and HR for early stage companies, spin outs, scale outs. We're very focused on the tech and life science industry. And we work with hundreds and hundreds of VC-backed companies in that space. But we're super happy to be involved in the equity administration side. And Tom, really appreciate you taking some time today to chat with our audience here. A really interesting topic, secondary markets. And of course, because we work so much with venture-backed private companies like tech companies and life science, this is a really interesting topic for them. We have seen a big uptick, as you're going to talk about, in this sort of activity at these companies as they try to get their employees some liquidity. So definitely interested in the topic, and I think a lot of people will learn a lot today.
Thank you, Martini. Thrilled to be here.
Yeah.
Well, Tom, let's just so we set the bar correctly. Can you just give a quick overview about how a liquidity program works, just so for those people who've never participated in one or understand how they work?
Sure. Yeah, and just to set the context, and I think everyone's aware of this, but if you look at the number of publicly traded companies in the last 25 years, the number has dropped by nearly half. There was over 8,000. Now I think there's just over 4,000. You go back a decade, there were about 50 private market unicorns. Now there's 1,500. So something big and important and profound is happening in the capital markets. And the output of that is that there are more private companies, and those private companies are getting larger, and they're waiting longer to IPO. We're coming up on our fourth year of an IPO drought. It's gone on so long that people are wondering, is this permanent? I.e., has something fundamentally changed in terms of private companies' desire to ultimately be public? So as long as there's more private companies, and as long as they're waiting longer to IPO, that creates liquidity pressures for founders and C-suite managers. It's kind of hard, Kareem, when you hire a 25-year-old software engineer to tell them to wait till they're 40 to buy their first house. And the average company now waits close to 15 years to IPO. So that's a pretty realistic time frame. If you want to attract and retain and hire the best talent, and there still is a war for talent, and if you just happen to live in a space like AI, there is a vicious war for talent. Your employees expect liquidity. And so that happens in its most basic form in a tender. And this is the core product that NPM offers. In a tender, the private company is our client, and they hire us to essentially effectuate a share buyback. These tenders started in the early teens, 2013, right after the Jobs Act. The first generation of companies to do tenders were Facebook and Groupon and Zynga, and they were very complicated processes, largely done on emails and spreadsheets, just getting the cap table straight and making sure that people didn't sell shares that they didn't own. They were laborious, they were long, they were expensive, oftentimes unsuccessful. And so we created a product about 12 years ago to really automate the tender process. So since then, we've done over 60 billion in tender volume. We'll do somewhere around 100 tenders this year, probably close to 10 billion in volume. So the tender really is now viewed, I think, by many private companies, Kareem, as a standard HR benefit. The same way you offer 401k and medical benefits. Well, if you're a private company, especially if you're competing against a public company that has 3-year cliff vest RSUs that employees can sell into their Charles Schwab account, if you want to attract and retain and compete for talent, you have to offer regular windows of liquidity. So that's what we do here at NPM.
Tom, would you say there's a size of company that is like before a certain size, they shouldn't be even considering this? Is there like a cutoff point where you think, is it a age of the company? Is it number of employees? Is it how much revenue? Is it stage of funding? I'm just interested.
Yeah, well, I'd start by saying there's a success bias to tenders. Companies that are succeeding do tenders. Companies that are struggling don't, right? If you're a struggling company worried about running out of capital, you're not particularly worried about employee liquidity, and your equity is probably not rising in value. So even if you were, it probably wouldn't be helpful. So the companies that most frequently run tenders are the ones that are succeeding. The typical profile, Martini, is Series C or later. We do some Series B companies, but usually they're a little bit too early on. So I'd say Series C and later, and the typical profile would be a company that has just done a primary round at a significant step up to their last. So they last raised money, 2 years ago at a $300 million valuation, and they're raising money this year at a $5 billion valuation. Well, all your employees can get out their pencil and on the back of a cocktail napkin work out about what that means to them. And then all of a sudden the calls start coming, well, when do we get to sell? And for a lot of managers, that pressure literally becomes irresistible. And so they then turn to us to run a tender for them. Now, tenders come in a couple different forms. One is if the company has the money, that use case I just described, they just did their Series C, they raised money, they want to take part of those proceeds and offer liquidity as an investment in their employees. That's a pretty standard straight share buyback. Increasingly, what happens is that private companies come to us and say, listen, we'd very much like to run a tender, but either we don't have the capital or we don't want to use our capital for that purpose. So NPM, can you please go try to find an investor to underwrite our tender? And then that's really interesting for us because it gives us an opportunity to go to market, tell the company story, bring high quality investors in, oftentimes that will for the first time be coming onto the cap table. So that's the part of the job that we really enjoy.
Yeah, that's great. And actually, that's an interesting signal to the market too, because I've been thinking about this early stage companies as they're attracting funding. They want to make sure VCs are going to want to invest in them, but it's almost as if secondary sales and tenders have become normal now. So it's not a bad signal that you can't raise money other ways or whatever. It's really interesting, especially when they do it professionally with a firm like yours, where it's very clean, very organized. I think it's a great option for companies.
Well, it's such an important point that you raised, because I think historically secondaries of all shapes and forms, and tenders are one form, there are others. Historically, I would say the kind of big VC Sand Hill Road community really looked poorly on the idea of secondary, because the idea was like, hey, I just put money into your company and now you're cashing out and our interests aren't aligned. And does that send a signal that, you as management or you as an early round investor aren't committed to or don't believe in this company? And that negative signaling was, a big reason why some companies never did tenders. Well, I tell you what, the market got over itself on that topic a long time ago, or at least in the last few years, because it's just the reality. Again, back in the year 2000, where the average company waited 5 years to IPO, sure. Hey, tell people, wait 5 years and we'll IPO and we all get liquidity. Well, when it's 15 years, and some of the biggest companies in the world right now are sort of hinting they may never go public. And that's a whole nother discussion is, what are the incentives or disincentives around being a public company now? But if you're a private company and you may never go public, well, how are you going to incentivize your employees to keep working and offer them liquidity so they can buy houses and wedding rings and pay off loans and all those things that mortals do? Really, really hard to do that without some regular cadence of liquidity, which is why I said, it's sort of starting to be a basic HR benefit. So all those conversations about negative signaling, I think there's just a cold, hard reality of 2025 that almost never comes up anymore.
And a big issue too, a big concept about these offerings is that it isn't somebody gets to sell all of their shares. Like if you're with a company that goes public, all of your shares suddenly go into a pool that after the lockup you can sell them. But with these tender offerings, it's a percentage. I mean, Tom, what would you say is the percentage that you see companies allowing their employees to sell? Is there kind of a standard number?
Yeah, there is. I'd say on average around 15%. Sometimes that fluxes up to 20, sometimes as low as 10. But that's the general rule. Obviously companies want to give employees liquidity to live their lives, but they don't want them fully cashing out so they can leave. And so I'd say the average tends to be around 15%. The average company that we service does 3 tenders with us before they go on to wherever they're going to become. And the average cadence is about every 18 months, although we do have companies that will do multiple tenders within a year. Those tend to be companies in very, very fast growing sectors like AI. If your valuation is doubling every 6 months or tripling every 6 months, we'll see those types of companies do tenders at a more frequent cadence. But I think on a general basis, you're talking about tenders about every 18 months, about 15% of vested holdings.
And Tom, I think too, just to make clear to everybody, the company is really in control of how they want to design this. So for instance, we see a lot with ex-employees, it's either you sell 100% of your shares or none of your shares. And I've seen tenders where it's you have to be fully vested before you get to participate. So it's really up to the company to decide how they want to design this. And I think working with your team, they can kind of understand best practice, but in the end, they have to think about what their motivation is for doing this and what their goals are as they design this. Is that correct?
That's a great point, and that's all very true. So the first thing I'd say about a tender is they're completely discreet. That's really important. When a company hires us to do a tender, we sign our life away in confidentiality agreements. I can't even tell you who my clients are. I can't tell you who participated, how big it was, what the price, nothing. And that's how the companies want it. These are very discreet programs. That's important to virtually every client that hires us. To your second point, control. The company controls every single element of a tender. How much employees can sell, who gets to sell, what they get to sell, vested, unvested, employees that have been here since 2000, before 2019. They control the price of the tender, the allocations, everything. Is a very controlled process. Again, really, really critical to companies to have discretion and control. And yeah, you're right. A lot of it is, what are you trying to solve for? Are you really just trying to attend to the liquidity needs of your current employees? Okay, well, maybe then that's all who's eligible. A lot of companies, one of their objectives is managing the cap table. Maybe they want to buy back some equity. So yeah, they'll include former employees, and for them, it's all or none. It's not 15%. It's either you sell us everything or you sell us nothing, because what they're trying to do is, control the cap table, buy back some equity from former employees. Another objective may be taking out early round seed, Series A investors. You're going to think I'm joking with this analogy, but I'm not. A very typical use case is a founder who borrowed 150 grand from his mother-in-law, 11 years ago, and it's now worth $27 million. And your mother-in-law is calling you every 48 hours saying, when do I get my money? That is a very typical use case, and that's an awkward situation. So sometimes with those very early seed round investors, similarly, all or none, we'd like to buy your shares. Sometimes it's just because of personal conflicts like that. Oftentimes those early seed round investors that got you from 0 to 1, are not going to be the investors who are going to help you become a decacorn, then beyond that. So sometimes it's just a rotation of investors to kind of the next round of strategics that you want on the cap table. So those are typically the use cases for why companies do tenders. It's either employee liquidity or managing their cap table for one of those purposes.
Right. Well, Martini, just to you touch on two topics that are important: tax and accounting. So can you just comment on those? Some employees may not understand, am I taxed on this? How does that work? And then the other question is, as a company, should you be concerned about the accounting of these programs? Does it matter how you design it? So maybe just touch on those two things.
Sure. I think it does matter how you design it, but at the end of the day, these generally are taxable events for the employees. It does depend very much how you design it. We would generally say you have to have a tax professional in the mix when you're designing your program. And you need to understand, is this going to be a taxable event for my employees? Does it run through the W-2? In which case you're then also paying employer taxes. So there is a real cost to running these programs to the company from a P&L perspective. So there's two kinds of compensation, right? There's the compensation that somebody is taxed on that shows up on a W-2 or a 1099. And then there's this sort of more nefarious concept of GAAP compensation, where it is a non-cash charge that runs through your P&L. I would say most companies tend not so much not to care about it, but that it is certainly non-cash, but it is a real number. So generally speaking, and when the company's working directly, like with a Tom at NPM, if the company's highly involved in the secondary, you're certainly going to have a gap compensation charge. And if the price is over the 498, of course, you're certainly going to have a gap compensation charge. And there's a whole decision tree you go through. Is the company involved? Is the company showing financials, which would otherwise be private? Is the company facilitating the transaction? All these things kind of lead towards that concept of there needs to be a compensation charge run through the P&L. And so, but I would say if I was a founder or a company management, when I'm trying to design a program, first of all, understand the tax ramifications for your employees and how they should be reported. Secondly, worry about the gap compensation, because if the answer to the first one is that it's taxable and runs through the W-2, it automatically shows up on the P&L. So the first person to go to is your tax firm and your tax professional. Second, worry about the accounting. That's how we think of it, Tom. Anyway, you might have a different opinion.
No, I think you articulated it perfectly. There are a lot of very complex and nuanced tax issues, NSOs and ISOs and RSUs and options. And that's just for employees. For the companies, they're equally complex. So yeah, the first motion we're not tax advisors. We have a very good network of tax advisors that we refer people to, but it's just not our business. And you need a lot of specific knowledge about the business and where they operate and what they do. So we don't provide those services, but we refer to people who do. But yes, the first motion of most of our clients that are contemplating tenders are tax advice and legal advice. It starts there. And oftentimes those are both actually referral channels we'll get from our tax partners or our law firm partners will call us and say, hey, one of my clients called me and they're thinking about running a tender and can you help them? So you're exactly right, Martini. That's the right first move.
It's become so, well, common is a wrong word, but like even when we talked about taking seed investors off your cap table, every seed fund is thinking about the way their capital should be liquidated, and they're interested in, taking money off the table as they go through the life cycle with the company. And because it's become so much more common now, like I was involved in some very early tenders such as this that were much more privately run. Nobody knew what we were doing. The tax accountants didn't know what to do. The lawyers didn't really know what they were doing. It's become so much more common, and there's such a body of evidence now. There's like a ton of experience out there from professionals on how to manage these programs. So someone shouldn't be trying to work it out on their own. If you're doing it now, it's been done before. Let's get some expert help.
I agree. And one of the sort of informal services that we offer here is referring our clients to other CFOs at GCs and companies who have been through similar challenges. There's always a lot of demand for that sort of informal networking. And we find the CFO community in particular is very collegial and helpful. And if you call and say, hey, I understand you might have run a program earlier this year, and I think we might have some similar challenges. And how did you attack this problem? We find that informal networking is very, very helpful.
Yeah, and we shouldn't forget too that many of these are global. So you're not just dealing with U.S. tax issues. You're not just dealing with U.S. employees, but Ken, you'll correct me if I'm wrong, but you do have KYC requirements, know your customer. And you've got people in other countries. And I can remember in early tenders, we would go and say to someone in another country, we need your driver's license or passport or whatever. I think we needed their utility bills too. And they just refused to give it. They're like, no, I'm not giving it. And we were at a real difficult situation where, well, then you can't participate. So I think that's another thing. The whole global aspect of this is something to think about as you're designing this is, are you willing to support people outside the United States in this program?
Yeah, I mean, it's a tender is a regulated process. NPM, we have a broker dealer called NPM Securities. So when you participate in a tender, you have to open up an account in our U.S. broker dealer, and we have to AML KYC you and all those normal processes. So if people don't want to participate in those, then they can certainly opt out of the tender. But given it is a regulated process and we're a regulated broker dealer, those are really non-optional steps that we need to go through, no matter where you're domiciled. That's just kind of how the process works.
Yeah.
Tom,
so you've been. Oh,
Tom, I just have a question for Tom, just on that note of going through that process. If somebody comes to you today and says, I'd like to be running a tender, what would you, and it's a large private company that has all of the metrics that you mentioned about being able to run this. Is it a 0 to 6 months before you can get it live? Like, give us a sense of the timeline. What would be the expectation, and how long will it take to get the program up and running and actually selling shares?
Yeah, we like to have about 30 days. By regulation, that's for the pre-program setup. And then by regulation, the tender needs to be open for 20 business days. So then you're at 50. Call it another 5 martini post for settlements and wires and all that stuff. So that's ideal. We have certainly done it, and this happens at the end of the year. We'll get a call on December 7th, someone saying, I need to do a tender by the end of the year, and then we scramble. Partly it comes down to, again, where's the capital coming from? If the company's funding the tender, i.e. they have it on the balance sheet, we have gone from 0 to open in 48 hours. So we can move very, very quickly. If we're not redlining NDAs and customizing, deal terms, especially if it's someone that we've done a few programs for before, we can stand these things up pretty quickly. Where it gets more challenging is if we have to go bring a third party in to underwrite the tender. Very hard to do that in 24 hours. There are some companies that we could, if you're one of the hot, AI space names that everyone's looking for. Yeah, we could probably help under short notice, but companies like that tend not to need capital because they've got all they need for let's call it a normal company. If there's a process where we're going out and bringing investors, minimum 30 days, that could take twice that because we're just having to go out. It's a mini road show, right? We're telling the story, we're putting a pitch deck together, we're playing matchmaker, and it's a hard process to rush. So I'd say if the company's funding the tender, could be very quick, but ideally kind of like that, have that 30 days, 20 days, 5 days, that would be sort of the dream state, could be accelerated. But if you're actually asking us to do cap intro, then, a little bit longer than that.
Awesome.
Well, another thing I think that's going to impact that timeline, and Martini, I want you to comment on this, is whether your cap table's clean. And you mentioned it earlier, Tom, but let's talk a little bit about that, because if you're 90% sure it's right, I don't think you want to do a tender, right? So
the importance of keeping I think this is such an old story that your cap table has to be the most pristine thing about your company. And so most of our venture-backed startups, and typically you've gone through rounds of diligence. So technically speaking, your cap table should be clean, but it's been some normal rounds with institutions where the cap table still has some missing pieces. Either the cash hasn't been recorded for shares that were actually sold, or, we did issue those shares, but we can't find the board resolution or whatever. So using a professional firm, whether that's your lawyer, certainly in the early stages, companies tend to use their law firm, but be on a platform. Don't be running your cap table on a spreadsheet. There's so many good products out there. I'm not going to talk about any of them here because, there's lots of really good ones, but use a platform, use a professional, whether that's your law firm or a firm like ours, to manage your cap table. Just make sure someone's reconciling it. And as the founder, you should be looking at your cap table and make sure you're recognizing the names on there. So yeah, I think it's pretty important. Super important.
I'm not nodding in violent agreement, Martini, because I would say it is the rule, not the exception, that when we start engagements, the cap tables are incomplete. Depending on whether the company's DIYing it on a spreadsheet or maybe using a third party, depends how incomplete they are, but they're almost all incomplete. And you're right, they have to be pristine to run a tender, or bad things can happen. So that's always the first step, and that can be time consuming depending on how much work there is on reconciliation. The other place, and actually this for me is the funnest part of a tender, generally when we do one, we start off with a town hall. And, a tender is an interesting thing. It's been called the IPO alternative. And certainly it's not the same sort of life-changing event, of an IPO. It's what every private company employee dreams of someday, that they'll be maybe standing up on that podium. But it's not that far from that, especially if it's a company that's doing their first tender. I talked about the success bias, companies that do tenders are winning, they're succeeding. And oftentimes, this is the first time that employees have really felt the success, oftentimes of a decade of hard work. And we see this because the average employee in our program gets about $500,000. That's the average. And so, we wire the money and they go from having $800 in their checking account to now $500,000. And it's life-changing. And it's just fun to be part of that. And so we start off every engagement with the town hall. And you'd be surprised. I would say generally financial literacy in this country is not what it should be. But a lot of employees don't know what tenders are. They understand conceptually that they're probably going to be able to sell some shares, but really what it is and the details. And Martini, we always get tax questions. We always get wealth referral questions. And so we try to support with, referrals on both of those fronts. But it's really fun to engage. Oftentimes, we'll have thousands of employees, literally they all show up to this town hall, trust me, because they're all quite interested. And we get to talk a little bit about who we are, explain how the process works, what a tender is, what their expectations should be. And it's really, really a fun part of the process because there's, like I said, it's not the same thing as an IPO, but it ain't that far away from there.
Yeah. I heard this story recently. A stock administrator was sitting down with this woman who worked for a manufacturing company, and she'd been there 9 years. And she said, so let's pull up, your account and let's take a look at it. And so they're kind of showing her how to read, what she has. And at the end, she says, well, this is great. Can we pull up my account? I want to see what I have. And the woman's like, this is your account. She's like, but this says I have $200,000. And she's like, yes, you have $200,000 worth of stock in this account. She said, I had no idea. And to me, the moral of that story is for 9 years, this woman didn't know, there was no motivation. There was no retention. She didn't know. So I think these town halls are good just to remind people, hey, you're not just getting your paycheck every month and your benefits are paid for, you're getting more than that. But Tom, one thing I hear from people who ask me about tenders is, well, if I do one, then am I kind of stuck? Like, do I have to do it every year now? Is there an expectation? Are my employees going to bug me every 5 minutes? Like, when's the next tender? Are we setting people up for that? What are your thoughts on that?
Yeah, my advice to companies is that you really do need to take affirmative control of your employee liquidity. I think some founders may just hear no evil, see no evil, I'm just not going to deal with it. But Kareen, this because you've been around this space, a while. If employees need to buy a house or a wedding ring, or they're getting divorced or whatever, and they need liquidity, they'll get it. Now, they may do something you don't like. There's a whole black market in these things called forward trades where employees will essentially do an off cap table derivative at obscene fees because they need the money, or they have some very, very predatory lending products that are in the market against private shares, and they'll go do those because if people need money, they need money. Mm-hmm. And that's bad for your employees. It's bad for your culture. It's bad for your company. So I guess, am I locked in? You're not locked into anything, and life changes. But if you keep succeeding as a company, I think I would look at it the other way to say, if I'm announcing, okay, our intention is every 18 months to do a tender, it's sort of, I don't have to have the conversation, right? Mm-hmm. This is my plan. Life can change. Maybe it extends, maybe it shortens, but you should plan on something around every 18 months doing a tender. Again, the company has full control. They can do it a larger tender, a smaller tender. They can narrow the aperture of who's available or who's not. So you're not held to anything. But I just think, like most things in life, being clear and predictable actually makes life less stressful, not more. And it's going to prevent your employees from doing something that are really not in their best interest.
That's a great point. And I think that whole concept of employee retention, being transparent with your employees, because it is a little tricky balance on being transparent on what was the round raised at, what is the new 409A. I think the world has become so much more transparent now that like 20 years ago or 15 years ago, people had no idea what the latest common stock price was. Those days are over. So any founder that's still living in that world really needs to think, and our management team really needs to think about this information is going to be public, whether it's that employees are telling each other what they got granted granted at or whatever. Let's just all be transparent, make sure people are aware that it is company confidential, and have good corporate governance around stuff like that, that people are signing. Company information is confidential, that kind of thing. Have a good corporate culture around what company information stays inside, and really be transparent with your employees if the goal is to keep them and to continue to compensate them.
Yeah. Well, we're coming up to the end here, but let me ask one more question for both of you. So if I'm an employee, first of all, I have a stock option, so I don't own the shares. I assume I can do a same-day sale, and, the company will help me through this, so I don't have to go borrow, as you said, money from my mother-in-law or something. Who do I ask for advice? Who do I talk to? Do I call County? Do I call NPM? How do I know whether I should participate or not? What are your thoughts, either one of you, on that?
Gosh, well, my initial thought is if the company is offering a tender, they're going to have some, whether it's their people organization is going to be able to give people not personal tax advice, but some good information. And then, of course, there will come a point where they'll say, if you're trying to determine, your personal situation, you need to go talk to a tax professional. But most good companies will offer good information around the actual offering, like what the percentage is, whether it's taxable, etc. Shouldn't be a surprise to the employee how they're going to get taxed on it. Tom, do you have a different opinion there?
No, I agree, Martina. Every process, first with the company, then with the employees, starts with education. And you'd be surprised, Kareen, in general, a lot of founders are heads down, focused on building their business, and their general level of awareness around liquidity and how these things work, it's just not been on their radar. And then all of a sudden, it kind of comes at them as an imperative. So it starts with educating founders and management teams on how this works. They always have two concerns. First is this going to be a massive time suck? Am I going to have a 3-month work stoppage? And that's where working with, an experienced team like NPM is helpful, because that's our specialty, is making sure that this is not a distraction, that we got this, and you're going to be able to do your day jobs. The second is that it's going to be unsuccessful and that it's going to fail. And that has happened, but it happens very, very rarely. So that's where we start with management teams. Martini's right. Then with employees, there's always a lot of tax questions. There's, what do I sell? In what order do I sell them? And then on the other side, once they realize, well, for the first time, well, what do I do with it? I've never had money. What do I do? How do I set up an investment plan? Who should my tax advisor be? How should I think about insurance? Money is a blessing, but it comes with complications. And so we try to help, on both ends of the spectrum.
Yeah. And I think there's wealth management firms out there that will help. If you don't have a wealth manager relationship, I think you can find it. Many companies will bring them in. I remember a tender I worked on many years ago. There were 18 people that were eligible. And we brought in a wealth management firm, and they were sitting in the conference room. And at the end of the day, I went to the guy from the wealth management firm. I'm like, how did it go? And he said, well, we opened 18 accounts. And I said, oh, that's fantastic. He's like, yeah. I said, so how much did you talk about the tender? And he goes, not much. These are people who are like, can you explain a 529 plan? I just had my first child, or I don't really think I'm insured at the right level. And so I think in a way it was a great opportunity for these, mostly in this particular case, young people who were like, I don't really spend time talking to people about my financial situation. And this was a reason. And I think they were appreciative of the company for, yes, they made money, and that was great. And as you said, it could be life-changing wealth, but it was also just time to sit down and say, okay, I'm a grown-up now. Time to start thinking about, living life like a grown-up.
Our average client is in their early 30s. And that's the time to start buying houses and getting married and having kids. And need to think about wills and insurance and 529s and retirement and all those things. So all of that tends to coincide, around the tender, which is why, as fiduciaries to our clients, trying to help answer those really, really important questions is important. I don't know if anyone's ever seen the 30 for 30 broke, about all the professional athletes that have made over $100 million that went broke. And that's the kind of thing that can happen if you're not mindful and thoughtful and cautious around financial wellness. And so we try to help with that as well.
Yeah. Well, this is fantastic. This has been really helpful. And I'm sure people have a lot of questions, and they can reach out to Martini or Tom. I'm sure, Tom, your team would be more than happy to answer the questions. We're going to show a QR code in a moment if you want to take a
Thank you again for listening and watching, because this part of information was all about how you take care of your people, your employees, and your stakeholders under environmental sustainability and governance called ESG, where we have been proactive through Meta Exchange, being a now Nasdaq Private Market listed company, and as well as running a private wealth management through Maxwell Rand. This is exactly what we do. We sit down with the clients, private equities, fund managers, broker dealers, and establish a syndication of knowledge base that ultimately helps and empowers the visionaries, the leaders, that they are looking at the next generation of what we talked about at Asia Pacific Broadcast Union, innovation with conscience. That gives you the ability now to bring that kind of venue into the formation. And naturally, one of the things that is extremely important for everyone to understand is like winning a lotto ticket. When your stocks hit the market and you get rich, you want to keep it, you want to sustain it, you want to do wealth management against it and leverage against it, not just by selling. Because when you sell, you have nothing to show. But if you leverage, you build portfolios. And with the portfolios, now it gives you ability for wealth managers and institutions, not only to help you in this generation, but for your children that they are coming. And remember, there is another side of this equation, because I've been in AI since 1986. And I can tell you one thing, it is going to take up your jobs. It is going to change the way that we are operating with the human agents. We are part of that equation ourselves. We know what is going to happen. So, but we have to embrace humanity. We have to retrain them. We have to bring them into a new formation. And those are the things that we feel in relation with the Tek Talk and talking to our audiences in here are extremely relevant. In short, before I conclude my presentation, I want to share something with you that will be a featured presentation shortly when we sit down and tell you more about it. So what we are going to do in here is share a screen with you that it just got published and it came to us, and it's explaining that JP Morgan is going full on crypto. After the regulations and changes and having a stable coin becomes part of the digital economy in the new cryptocurrency, now a $4.3 trillion bank giant is now planning to offer crypto-backed loans using Bitcoin, Ethereum as collateral. This is tremendous opportunity for those countries and GeoIPs if they don't seize the opportunity. So timing is extremely important because everything is moving very fast. You get news every day. And imagine now you can take your investment and build it into another portfolio of crypto and borrow against it and leverage for your families. So that is one of the reasons that JP was once heavily against crypto. Now Jamie decided that Bitcoin, that he was calling it back in 2017 a fraud, now is a new standards that the institutions such as Fidelity, other organizations, that they're all coming on board. They're going to take the BTC and the ETH as the first round of a cryptocurrency. And JP Morgan secures the loan with no chain collateral. This is extremely important, okay? And those of you who have been victimized or part of the crypto scam or pool rug or rug pool, depending on how you look at it, that the promoters, they come in and they put the threshold and they get you excited because you're going to get rich. Now you have legitimate way to increase your wealth through institutions that builds your family's portfolio rather than just dumping it into an emotional decision with a couple of changes on the screen that they show how your money moves and how much money you got, but in reality it's only a digit and it has no substance. So this is a huge adaptation that it gives Bitcoin and Ethereum a real utility. And because we are working on projects ourselves, such as AI TV, and we plan to create that kind of venues for that kind of monetization for our broadcasters and clients, we wanted to let you know that these are anymore a DeFi or TradeFi, but they are merging now all together to give you that capability that otherwise you would not have. So you have to look at your startup companies. You have to look at your way that we are growing the business. And more importantly, how do you want to bring that liquidity in the most sustainable ESG environment that gives you generations, not just a pump and dump and moving from one company to another company and being a drifter. So that is the message that we wanted to bring to you. Mr. Vijay, if you have any comments, please feel free to make.
Thank you very much, Dr. Moradi. That was a very engaging video by Mr. Tom Callahan, the CEO of the Nasdaq Private Market. As the private markets mature, liquidity can no longer be improvised. It must be structured, secure, compliant, and trusted. That's what the Nasdaq Private Market delivers, from enabling shareholder liquidity to attracting strategic capital. NPM is no longer optional. It's becoming the new standard for companies that want to scale with confidence, retain control, and meet global expectations. Now, the success of Meta Exchange AI Inc. from zero to a $300 million market cap is proof that private companies can now access capital without giving up governance and do it in a way that satisfies shareholders, regulators, and long-term investors alike. Capital isn't just about money, it's about trust. Compliance isn't just about regulation, it's about resilience. And growth isn't just about speed, it's about structure. Thank you for joining us for episode 2 of Unlocking Capital and Compliance: How the Nasdaq Private Market is Reshaping Private Company Growth. As this series concludes, remember this: the future of private capital is already here, transparent, compliant, and built on infrastructure you can trust. I am MVJ signing off. Thank you to our sponsors: K Media Marketing, Borneo Post, Utusan Borneo, Oriental Daily, Sihua Daily, TFM, and our speaker, Dr. Ahmad Moradi of Maxwell Rand, and also the CEO of Meta Exchange AI Inc. Thank you very much for joining
Thank
us.
you for having us. Ciao.